Across the United States, the economy seems pretty stable, right? Stock market indexes are chilling near record highs, headlines are celebrating big corporate profits, and it looks like everyone is out shopping and spending. But just beneath that shiny surface, a quiet but powerful shift is taking place. This is a shift that could reshape markets, entire industries, and your everyday life over the coming months. And here is the most important part. Most people want to even notice it until it hits them directly. So let's break down this hidden shift so you know what Wall Street and everyday Americans need to be aware of right now. First, let's talk about the calm before the transition. For months, the markets have been climbing steadily, creating this feeling of normalcy. Wall Street is reporting record trading volumes, and big tech and growth stocks are still leading the charge. Consumer confidence also looks pretty positive. But if you talk to seasoned investors and market analysts, they're sensing something different. It's not panic, not at all. It's more like hesitation. Traders are watching risk a lot more carefully. Big investment funds are quietly reallocating their money, and corporations are focusing on managing their cash reserves instead of going all in on aggressive expansion. This subtle change in behavior is what often comes before a major economic adjustment. History has shown us time and time again that these quiet changes in sentiment matter a lot more than sudden, dramatic shocks. It's not just Wall Street. Consumers are shifting their tactics too. American households are definitely still spending, but they're spending differently. Big luxury purchases are being put on the back burner. We're seeing stable demand for essential goods, the things we can't live without. But spending on non-essentials, what we call discretionary spending, is slowing down. People are also getting more cautious with credit. They're prioritizing paying down debt and building up their savings. Now, this careful approach doesn't really show up in the short-term economic data, but it has huge long-term consequences. Industries that rely on you buying those nice-to-have items will start feeling the pressure first, while businesses providing essential services will likely stay resilient. And what about corporate America? Well, they're quietly adapting. Large corporations rarely go on TV and announce they're feeling cautious. Instead, they make adjustments behind the scenes. They start by slowing down hiring in roles that aren't critical to their core business. They shift their focus from aggressive expansion to improving efficiency and boosting their cash flow. And they avoid making speculative, risky investments until the market shows a clearer direction. For them, the goal right now is stability and adaptability, not grabbing headlines. The companies that master this quiet strategy are the ones that usually emerge much stronger after these kinds of economic transitions. One of the biggest hidden forces driving this entire shift is debt. It's a massive factor. Companies that borrowed heavily when interest rates were super low are now facing much higher costs to refinance that debt. On a personal level, consumers with adjustable rate loans or growing credit card balances are really starting to feel the pinch. Even governments are having to balance their budget priorities with the rising cost of interest payments on national debt. Now, debt doesn't cause an immediate collapse. Instead, it slowly chips away at flexibility. It makes the entire system more fragile and vulnerable to any unexpected shocks that might come along. This shift isn't happening the same way everywhere across the country either. There are significant regional differences. Take high-cost cities like New York, San Francisco, or Los Angeles. They are heavily dependent on the tech and finance sectors. The higher levels of personal and corporate debt in these areas make them much more sensitive to changes in interest rates. Then you have the Midwest and other industrial hubs. Their manufacturing and energy sectors tend to adjust more slowly, but changes in global trade and supply chains have a very direct impact on them. And finally, look at the growth regions in the South. Booming population growth and lower costs of living can create a buffer against some of these pressures. Industries like logistics, energy, and infrastructure in these areas might actually gain an advantage. Understanding these regional dynamics is absolutely essential for investors and businesses who want to successfully navigate the changes ahead. The stock market itself is also giving us subtle signals about this shift. Have you noticed how even after good economic news, we sometimes see these minor corrections? Or how a rally is often led by just a handful of stocks while most others are lagging behind? And what about those moments when volatility spikes unexpectedly in response to what seems like a small announcement? These aren't signs of panic. Think of them as stress tests. The market is quietly testing the system, trying to figure out which companies are prepared for a change and which ones are overexposed. So why can our natural optimism be a little misleading right now? Americans have always believed in the power of innovation and technological growth, in the long-term recovery of the market, and in strong corporate earnings. And for the most part, that optimism is justified. But it also carries risks. Being overconfident during a transition phase like this can lead to bigger losses if reality does not quite meet our high expectations. Markets rarely just collapse overnight. First, they test our confidence. Understanding the difference between a real crisis and a confidence test is critical for both investors and everyday people trying to protect their financial future. So what are the savvy investors doing? They're already acting, quietly. They are rotating their portfolios out of high-risk growth stocks and into more defensive assets. They're making sure they have cash reserves ready to capitalize on any opportunities that might pop up when others are forced to sell. They're using strategies to hedge against potential volatility. And most importantly, they are paying close attention to these subtle behavioral shifts in the market, in corporations, and among consumers. Their approach prioritizes preparedness over prediction, which history shows is far more effective during periods of market transition. So here are the key takeaways. The US economy is changing quietly right now. Don't wait for the dramatic headlines to start thinking about your strategy. Consumers, corporations, and investors are already adjusting. Remember that these subtle shifts in market behavior are often more important than short-term gains. Things like liquidity, patience, and smart strategic positioning will give you a competitive edge. And understanding the regional and sector differences can help you spot the potential winners and losers early on. Let me leave you with a final thought. America is not on the verge of collapse. It's reshaping itself. Some sectors will naturally contract, while others will grow, often under the radar. The investors and consumers who pay attention and notice these changes early are the ones who can benefit. The silent shift in the economy is happening right now as we speak. Those who adapt quietly and strategically are the most likely to come out ahead. History consistently shows that the quiet changes are what define the winners long before the dramatic headlines ever appear. Welcome back to part 2 of our series on the silent shift happening in the U.S. economy. In part 1, we talked about the subtle signs of change. Today, we're diving deeper into a critical question: who wins and who loses if these trends continue? Understanding this is the key that separates the prepared from those caught completely off guard. This isn't about predicting a crash, it's about seeing where the money and opportunities are quietly moving. Let's start with the losers, the industries and individuals who are feeling the pressure first, even without any dramatic headlines. Think about retail and discretionary spending. And when people get a little nervous about the future, what's the first thing they cut back on? It's not groceries or gas, it's the big ticket items, the luxury goods, the non-essential electronics. Online stores are still growing, sure, but their profit margins are getting squeezed by rising costs. The days of easy, explosive growth are pausing for a bit. Another group feeling the pinch is tech startups and other high-risk ventures. Remember when it seemed like any company with a cool idea could get millions in funding? That era is changing. Venture capital is becoming much more selective. They're not just looking for hype anymore. They want to see solid revenue and a clear, profitable business model. Companies that were running on fumes and big promises are suddenly very vulnerable. If the market's mood sours, their funding could dry up overnight. And we can't forget about high-debt corporations. During the years of super low interest rates, a lot of companies expanded aggressively, taking on huge amounts of debt to fuel their growth. Now, that debt is becoming a heavy anchor. As interest rates rise, the cost of refinancing that debt goes up, squeezing their profits and limiting their ability to invest or innovate. If their cash flow gets tight, their profitability can quickly decline. These groups aren't collapsing, but the ground beneath them is definitely getting softer. The longer this quiet shift continues, the greater their risk becomes. But it's not all bad news. In fact, for some, this environment is a golden opportunity. So who are the winners? First up are the cash-rich companies. Firms with strong balance sheets and a lot of cash on hand are in the driver's seat. While their competitors are hesitating or struggling with debt, these companies can make strategic moves. They can acquire weaker rivals, buy up valuable assets on the cheap, or expand into new areas without much competition. Their financial resilience isn't just a safety net. It's a powerful weapon for long-term dominance. Next, we have the defensive sectors. These are the industries that people rely on no matter what the economy is doing. Think healthcare, utilities, and essential consumer goods. People still need to see a doctor, turn on their lights, and buy food. These sectors offer stable, predictable revenue, making them a safe harbor for investors during uncertain times. While other parts of the market are volatile, these areas provide a sense of security and steady returns. Then there are the savvy, patient investors, the ones who didn't get caught up in the hype. Those holding cash or other liquid assets are now in a position of power. They can swoop in and buy quality assets when prices are low. A diversified portfolio protects them from big swings in any one sector. History has shown us time and again that patient, disciplined investors who focus on long-term value almost always outperform those who are just chasing short-term trends and quick profits. Finally, innovation that solves real-world problems is a huge winner. The market is shifting its focus from speculative hype to tangible results. Companies that offer real, practical solutions, things like cost-saving automation, more efficient energy alternatives, or software that genuinely improves productivity, are thriving. When times get tough, people and businesses are willing to pay for things that save them money, time, or energy. Real value is king. Now, let's talk about the silent force that's driving all of this, the consumer, you and I. Our spending habits are what truly shape the winners and losers. Right now, Americans are becoming more cautious. We're prioritizing essentials over luxuries. We're thinking twice before making that big purchase. This change in behavior, even if it's small, creates ripples that travel all the way up the supply chain, impacting corporate revenues and stock prices. The companies that understand this shift, that adapt their products and marketing to meet this new reality, are the ones that will thrive. Those that ignore it and keep pretending it's business as usual are going to find themselves in a world of trouble. It's also crucial to remember that this economic pressure isn't the same everywhere. The US is a massive, diverse country, and the effects are different from region to region. In high-cost coastal cities like New York, San Francisco, and LEA, where the economies are dominated by tech and finance, the sensitivity to interest rate changes is extremely high. High living costs amplify every little economic tremor. Meanwhile, in the Midwest and other industrial hubs, the story is more about manufacturing and global trade. Adjustments here happen more slowly, but a slowdown in global demand can have a significant impact on local jobs and revenue. Then you have the South and other high-growth regions. Many of these areas are benefiting from population growth and lower costs of living, which create a sort of economic buffer. Industries like logistics, domestic energy, and infrastructure are actually gaining an advantage here. Understanding these regional dynamics is key to seeing the full picture of opportunities and risks. So, how does all this translate to the financial markets? The stock market acts like a mirror, reflecting these subtle shifts in real time. The winners in the market right now are often dividend-paying companies which signal stability and consistent cash flow. You also see cash-rich mega-cap stocks doing well, along with defensive ETFs and bonds. The biggest winners, of course, are the long-term disciplined investors we talked about earlier. On the losing side are the over-leveraged startups, the momentum-only stocks that have no real substance behind them, and companies that lack consistent, reliable revenue. And, of course, the investors who are still chasing hype. The market is a lot less forgiving than it seemed a couple of years ago. Even small missteps or a bit of bad timing can lead to amplified losses during a transition like this one. And that brings me to the most important point of all. Timing is everything. History proves this over and over. The people who see the writing on the wall and prepare before the major shifts happen are the ones who come out ahead. Those who wait until the changes are all over the news are the ones who are forced to react, and they're usually playing catch-up from a disadvantaged position. This is why quiet observation and strategic positioning are so much more valuable than trying to make flashy, headline-grabbing predictions. So, what are the practical lessons for businesses? First, maintain healthy cash reserves. Cash is your lifeline during uncertainty. Second, avoid overexpansion. Now is not the time for reckless growth. Third, optimize your operations. Look for ways to be more efficient and flexible. And finally, monitor consumer trends like a hawk. Prepare for multiple different scenarios instead of betting everything on one single optimistic outcome. The companies that are quietly making these adjustments now are the ones that will emerge stronger on the other side. And what about for everyday Americans? Even if you're not a big investor, the shift matters to you too. In the job market, you'll see some industries slowing down their hiring, while others, like healthcare and logistics, continue to grow. On the spending side, mindful budgeting is your best defense. Creating that financial buffer protects your household from unexpected shocks. And if you do invest, even in a 401k, remember that quality and patience will always outperform chasing hot trends. By adapting at the individual level, you can turn these market shifts from a source of stress into a source of opportunity. Let's wrap this up. The US economy isn't collapsing, but it is quietly reshaping itself. Some sectors will shrink, while others will grow under the radar. The key takeaway is this. By observing quietly and acting strategically, savvy investors, smart companies, and prepared households can not only navigate this change, but actually benefit from it. As history has shown us, these silent shifts are where the next generation of winners is born, and where those who are unaware get left behind. Welcome back to the third part of our series on the U.S. economy. Today, we're diving deep into what the smartest investors and even major corporations are doing right now, quietly, behind the scenes. This isn't about hype or panic, it's about preparation, patience, and a level of adaptability that often goes unnoticed until it's too late for everyone else. First, let's talk about reducing risk before it's obvious. Seasoned investors live by one crucial rule. By the time the news headlines are screaming danger, the best time to act has already passed. So what are they doing? They're gradually trimming their positions in sectors that seem overvalued. They're reducing their exposure to companies that are carrying a lot of debt or are involved in high-risk ventures. They're also building up their cash reserves and quietly planning their exit strategies. This isn't about fear, it's pure discipline. It's a calculated move that the general public rarely sees until after the fact. The second major move is a strategic rotation into safer assets. Smart money doesn't just pull out of the market entirely. Instead, they shift their focus. They start moving into defensive sectors like healthcare, utilities, and consumer staples, the kinds of businesses that people rely on no matter what the economy is doing. They also favor dividend-paying stocks, which can provide a steady stream of income and stability. Bonds and other liquid assets are also key as they maintain flexibility. This rotation is a classic defensive play. It protects the portfolio from potential downturns while leaving the door open to jump on new opportunities that arise during a market correction. This brings us to our third point, and it's a big one. Cash is king. For the past several years, holding cash was seen as boring, a missed opportunity. But right now, liquidity is a massive strategic advantage. Having cash on hand allows investors to quietly buy up high-quality, undervalued assets when others are forced to sell. It provides critical flexibility if interest rates continue to rise, making borrowing more expensive. And perhaps most importantly, it acts as a crucial buffer against unexpected market shocks. History shows us time and time again that those who enter a market transition with cash often outperform everyone who was chasing momentum right before the shift. Of course, it's not just about defense. The fourth strategy is hedging against uncertainty. Smart investors are quietly using tools to protect their portfolios. This can involve using options or other derivatives to limit potential downside losses. They might also invest in low volatility funds or countercyclical assets that tend to do well when the broader market struggles. Another key hedging strategy is global diversification. By spreading investments across different countries and economies, they reduce their dependence on the performance of the US market alone. It's important to understand that hedging isn't about trying to predict a crash. It's about insurance, minimizing losses if unexpected events occur, so you can stay in the game. The real edge, however, often comes from watching subtle signals that most people overlook. This is our fifth point. While the mainstream is focused on the big, flashy headlines, the pros are looking at the underlying details. They're watching market breadth. Are fewer and fewer stocks responsible for driving the market's gains? That can be a sign of weakness. They're watching for small spikes in volatility. Are minor news items causing oversized market reactions? That suggests investor anxiety is high. They're also tracking credit spreads, which is the difference in borrowing costs for safe and risky companies. If that spread widens, it means lenders are getting nervous. And finally, they pay close attention to changes in corporate earnings guidance. Are companies subtly lowering their future expectations? These indicators often flash warning signs weeks or even months before the mainstream news catches on. And it's not just individual investors. Corporate America itself is quietly adapting. This is our sixth and very important point. Big companies are making strategic shifts without much fanfare. They are preserving cash reserves instead of launching aggressive, expensive expansion projects. They are focusing on improving operational efficiency, squeezing more value out of every dollar they spend. Hiring becomes much more targeted, focused only on absolutely critical roles. You might also see strategic mergers or acquisitions happening quietly, without the massive public announcements, as stronger companies absorb weaker ones. For these corporations, the goal right now is stability, not publicity. And history has proven this to be a winning long-term approach. The seventh principle that guides these actions is a focus on timing over prediction. The goal is not to guess the exact day the market will turn or what the precise outcome will be. That's a fool's game. Instead, the focus is on being prepared for multiple scenarios. If there's a minor correction, their defensive positioning will protect their portfolios. If a major shift happens, their liquidity will allow them to seize incredible opportunities. And if there's a surprise rally, they're still invested enough to participate without being overexposed and vulnerable. Those who prepare for different outcomes systematically survive and often thrive. Those who bet everything on one single prediction can lose everything if they guess wrong. So, what are the lessons here for the ordinary investor? You don't need to be managing millions of dollars to apply these principles. First and foremost, don't chase the hype. When an asset is all over social media and everyone is talking about it, you're likely late to the party. Second, always keep some liquidity or safe investments on hand. Having that cash gives you peace of mind and the power to act when others can't. Third, prioritize quality over excitement. Invest in solid, well-run companies with strong fundamentals, rather than chasing speculative trends. And finally, learn to observe behavior, not just headlines. Watch what the smart money is doing, not just what the talking heads are saying. Quiet observation and disciplined positioning will always outperform emotion-driven decisions in the long run. This leads us to our ninth point, the emotional edge. Markets are designed to test your emotions far more than your logic. Overconfidence after a long bull run can lead to devastating losses when trends finally reverse. Impatience can cause you to sell at the worst possible time, right before a recovery. The real advantage comes from patience and strategic observation. The ability to control your fear and greed is what separates the winners from the losers. It's not about being the most intelligent person in the room, it's about having the strongest emotional control. So let's bring it all together with our final thought. The U.S. economy isn't collapsing, but it is quietly reshaping. Those who notice these subtle shifts early, whether they're large investment funds, businesses, or just regular households, are the ones who gain flexibility, resilience, and opportunity. Those who ignore the quiet signals often end up paying a heavy price later. Preparation always matters more than prediction. And as history consistently proves, it's the quiet, disciplined actions, not the loud headlines, that define the winners in the end. Thanks for watching part 3 of our series. In our next and final installment, we'll explore the best case, worst case, and surprise scenarios for the U.S. economy. We'll look at how this shift could accelerate and what it means for markets, businesses, and everyday Americans like you and me. Make sure you're subscribed with notifications on so you don't miss it. See you in the next video.